Coming up on Business Incorporated, FAO and the International Renewable Energy Agency join forces to boost renewables in food and agriculture. Egypt launches European Bank for Reconstruction and Development and the UNWTO Tourism Recovery Assistance Package. And Seychelles to raise $212 million on international bond market to cover projected deficit. Hello and welcome, and thank you for joining us. I'm Chimeze Obi Iwagu. We'll begin the show with intraday market numbers, which were all positive amongst the markets we track here in Africa. Nigeria's main index advanced 0.99%, while South Africa's JSE index was 0.47% higher. In Egypt, the EGX 30 rose 0.58% to 11,454 points. Kenya closed positive on Wednesday. And those positive sentiments did not spill into the Middle Eastern markets at intraday as major indices were negative. In the UAE, Dubai's index declined the most by 0.70%, while the Abu Dhabi index lost 0.45%. Elsewhere in the region, Saudi Arabia's index 0.36% down, and then the Qatari index was the only gainer at intraday by 0.43%. And markets in Europe opened mixed today amid ongoing concerns over the coronavirus pandemic and political turbulence in the U.S. Let's get a sense of all the developments from the European scene, and Conrad will be doing just that. Hello, Conrad. Good afternoon again. Good to see you.
Good afternoon, Jimmy. I hope the weather in Lagos is not as cold and snowy as here in Germany right now.
Not at all. Not at all. It's very warm here. Actually, it's sunny and hot. I'm sure you will like it here. Anyway, enjoy your cold weather there. Meanwhile, Europe's largest economy has contracted 5% last year. Now, that's according to new data released by the German Statistics Office. Is the report all doom and gloom? And why has there not been a kind of a negative reaction on the stock market?
You know, Jimmy, this 5% contraction of GDP here in Germany last year, this exactly matches the forecasts of a majority of German economists had made before the release of the data. And that's why there was no negative surprise and no negative reaction after this negative data came out, because it is, of course, very negative. It's a huge contraction of the economy, and this after 10 years of continuous economic growth here in Germany. For the markets, the question now, of course, is not if, but when the recovery starts. As soon as the vaccinations of the population are really underway and ongoing, a strong recovery is expected. And let me tell you, something else is also positive. The fact that, the contraction of the economy, this decline of 5% in GDP, exactly matches the forecast is positive in itself. It shows that the forecasting quality of our experts is good. And that's very important, in particular for the financial markets.
Now, the governing coalition in Italy is on the brink of collapse again. What's the potential of this seriously disrupting the markets? And what does this mean for the COVID-19 relief aid Italy was supposed to get from the European Union?
Well, the COVID-19 rescue is now in jeopardy, really, because, we're speaking about a lot of money. More than 200 billion euros Italy is supposed to get from this COVID rescue package set up by the European Union. Italy is by far the largest beneficiary of this relief program. But for national reasons, the government in Rome has decided that it wants to oppose too many loans here because it doesn't want the European Union Commission in Brussels to have too much of a say in the way how the rescue money is used. That's, of course, a very small sort of political angle that the government in Rome is taking. And of course, it has the potential to seriously disrupt the markets, because it's a reminder of the dysfunctionality of Italian politics that, we've been seeing for decades in Italy. If this continues, of course, it will become problematic and very, very difficult to help the market up, the economy up again. And you know, the whole recovery scenario on the markets, the whole strong recovery of European stock prices in recent months, the strong euro at the moment, all this is based on the recovery scenario. That's now put into question.
And in another development, the government of France is raising concerns about food sovereignty if the Canadian convenience store operator takes over the French supermarket chain Carrefour. Does the government have a point here, or is this classical French protectionism? How is this being perceived on the markets?
You know, I found a quote from the finance minister in Paris who says that at first glance he was not in favor of this operation and that French sovereignty, food sovereignty was a key issue. This doesn't sound like he wants to, you know, prevent this deal from happening. This sounds rather like the French government says, hey, we want to be taken into consideration in this deal. Our interests and the interests of France should be respected. Let's not forget, Carrefour is the largest private sector employer in France with more than 105,000 jobs in France. So, of course, the French government wants to get involved. In terms of whether those two companies would fit, well, in particular, you know, Carrefour is running large supermarkets worldwide, but Carrefour in France is also running many smaller supermarkets, many in central areas of cities. And this would be a business that would perfectly fit Couche-Tard. And that's why, you know, we shouldn't expect that Couche-Tard would not respect the French interests and French jobs here. It needs the jobs, it wants complementary business, and it's likely that it just wants to take over all those shops in France in particular and include them in Couche-Tard's own business. Maybe some of the larger supermarkets might be sold, but that remains to be seen.
Well, Conrad, thank you for updating us on those. We have one more day to do this. So I'll see you tomorrow. It's a busy day for retail news as a flurry of UK firms reveal how well or badly they fared over the crucial Christmas period. And the first up was Tesco. Let's bring in Juliana now to tell us more. Hello, Juliana. Good afternoon again. Well, Tesco was the first to tell its sales results and has raked up record sales as COVID-19 lockdowns drove sales across the supermarket sector. What were the early reactions to these results?
Good afternoon, Chimeze. Mixed reactions, actually. The analysts appeared to be pretty happy with Tesco's results, but the markets weren't. Their shares are down 1.6% at Intraday, and that's even after these record-breaking sales over the festive period. They have shown that over the past 5 months, their online sales have been up by 80%. No surprises there. We've seen that everywhere, haven't we? Including Lidl, that appear to reign supreme amongst all the retailers. They also have shown that their like-for-like sales over 7 weeks to the end of December were up by 16%. So Tesco have had a really, really great festive period. At one point, they were doing over 400 million online deliveries. So they still are Britain's biggest retailer. But when it comes to the markets, they're a little bit concerned about how much they'll be spending over the next 12 months. Of course, COVID is still a huge cause for concern here in the UK. Supermarkets in particular have been under the radar because that's really where most people can go and do their shopping. All other non-essential stores are closed. So they've had to invest much more in making their shops COVID secure. And in this trading update this morning, Tesco have increased the amount that they're going to spend on securing their stores. It was £725 million. They've now increased that to £800 million. That's a concern for the markets. Also, Tesco Bank, that hasn't been performing very well. Over the past few months, there has been a decline in the amount of people taking out these new cards by 27%, and that's to the tune of £200 million. So mixed bag. Even though they've done pretty well, the markets aren't really that satisfied with these results.
And we're also hearing from Primark owner AB Food, online fashion retailer Boohoo, car and cycling retailer Health Foods, home furnishings group Donem, and of course a musical instrument maker Gear for Music. What are these retailers reporting?
Well, it's a mixed bag, as you said. Some analysts and economists are calling it Super Thursday because really all of this data and revenue does let us know exactly how the UK economy has been faring, particularly in that third and most importantly, the fourth quarter. Some standouts, really, of course, it's got to be Boohoo. They're still reigning supreme. They're the online fast fashion retailer. They were in a little bit of trouble, well, quite a lot of trouble over the past couple of months because there were suggestions that one of their outlets or one of their factories in Leicester was involved in slavery, really paying very, very low wages for people working within their stores. Allegations as well that because of how tight-fitted it was, COVID was running rampant there. But people are still shopping. They've got that market, that lucrative 18 to 24-year-olds. They haven't been able to go out, but they're still spending money on clothes, particularly loungewear. So they have shown that during the lockdown, their sales have increased by 40%. Their revenue grew to £660.8 million. So really, yes, they are reigning supreme. And for our viewers in the UK, I'm sure they'll all be familiar with cycling. Cycling was a huge new hobby that lots of people took up during the lockdowns. So Halfords, which is one of those cycle stores, they have shown that they've had a boom during their pandemic. They have reported growth of 12% over the past 3 months. So yes, it is a mixed bag. Lots of positive trading updates, but we're still very much in the midst of a third national lockdown. So we don't know if this is a flash in a pan or if these increases are something that we're going to expect over a longer term during 2021.
I'm sure with time we'll get to know. So what are the market numbers saying at intraday?
Well, it is Super Thursday and the markets opened pretty positively at the start of early trading. Even though there's political turmoil across the pond, investors here seem to, for now at the very least, be turning their back to that. And they were pretty buoyed by today's trading updates from the retailers. So the FTSE All-Share is up 0.58%. The FTSE 100 is up by 0.59%. And the FTSE 250, the domestic market, that's up by 0.80%. In the currencies market, the British pound is also up on the US dollar by 0.18%, up on the euro by 0.11%, and up on the Japanese yen by 0.25% at intraday, Chimmy.
All right, Juliana, enjoy the rest of the day. And in Asia, stocks were mixed today as investors regionally reacted to Chinese trade data for December. Mainland Chinese stocks declined on the day. The Shanghai Composite shared 0.91%, while the Shenzhen Component dropped 1.92%. On the flip side, Hong Kong's Hang Seng Index advanced 0.68% as of its final hour of trading, while South Korea's Kospi closed slightly higher at 3,149 points. In Japan, the Nikkei 225 rose 0.85%, while the Topix Index edged 0.48% higher. Over in Australia, the S&P ASX 200 gained 0.43%. MSCI's broadest index of Asia-Pacific shares outside Japan was little changed. And U.S. stock futures were mixed this morning as traders kept an eye on interest rates and lingering turmoil in Washington. Dow Jones Industrial Average futures traded 96 points higher. S&P 500 futures traded above the flat line, while Nasdaq 100 futures were in negative territory. The previous day, the S&P 500 and Nasdaq Composite gained 0.2% and 0.4% each. The Dow, meanwhile, closed flat. Wednesday's gains for the S&P and Nasdaq came after Intel rallied nearly 7% to lead tech stocks higher. They also followed U.S. interest rates easing from their highest level since March 2020. And domestic commodities market update is next. Okay, let's talk palm oil. Nigeria was once ranked among the leading palm oil producing nations in the world and was a key exporter of the commodity. But despite interventions from the federal government and World Bank to develop the palm oil industry and encourage local production, Nigeria has remained a net importer of palm oil. What are the factors responsible for this, and are there solutions? Mayowa Ige, one of the research analysts with Financial Derivatives Company, joins us now. Hello, Mayowa. Good afternoon.
Thank you for having me.
So despite being ranked among the leading palm oil producing nations in the world, Nigeria has remained a net importer of this commodity. What is the reason for this, and what can be done to improve palm oil production in the country?
So for over 30 years, Nigeria was the second largest recipient of World Bank funding for palm oil production. And it was supposed to be used to fund about 6 projects. But right now, only one of those projects survived. And despite all interventions from the federal government, there's still a shortage of supply. There's still a shortage of supply of palm oil in Nigeria. 2 factors responsible for this include number one, the fact that 80% of our palm oil producers are small-scale farmers with fragmented farming areas, and also the fact that we use outdated and inefficient farming techniques and machineries. And then other factors also include the fact that we use poor seedlings, there's poor infrastructure, and high interest costs on borrowed funds. So these factors have greatly affected the supply of palm oil in Nigeria. What the government can do, 3 things the government can do to improve the supply of palm oil in Nigeria is: 1, provision of farm settlements, large farm settlements for palm oil production. Also, giving lower interest on loans to palm oil producers, and then also investing in research and development activities that will help increase our productivity.
Now, the price of palm oil increased by about 57% before the border reopening and 21% after the border reopening. Now, what is responsible for the continued increase in the price of this commodity?
So prior to the border closure, there was the COVID-19 pandemic and its attendant impact. We've seen there was supply chain disruptions, there was high cost logistics costs, which affected commodity prices generally, and palm oil was not exempted from that. So, but right now, what we can see is causing the increase in prices of palm oil is seasonality. This isn't palm oil season, and also insecurity. Most of our palm oil in Nigeria is produced in the east and transported along major highways, namely the Benin-Ore highway, to different other parts of the country. And there's a lot of insecurity on that part of the road, and this has affected logistics costs. And both of these factors have added to increasing the prices of palm oil prices currently.
Now, despite the COVID-19 pandemic and, of course, the decline in economic activities in the first half of 2020, the revenues of the 2 major domestic palm oil producing companies, Okomo Oil Palm and Presco, the revenues of these companies increased. Now, their stock prices also increased and outperformed the NSE All Share Index. Are we likely to see a reversal in their stock prices?
So in the second half, the results we've been seeing so far, these companies have still been recording increases in their revenue. However, their profit after tax has been declining. And this is not because they haven't recorded higher sales. No, it's more of the issues are from higher cost of sales, higher administrative costs, and also losses in their asset disposal. But the problem now is that if this trend that we've seen so far, if these trends are not addressed, then we might see a reversal in their stock prices in the short term. But long term, we expect to see an upside to their a positive upside to their stock prices, seen as agri is one of the sought after sectors for investing currently, because everyone is looking for a way to diversify their portfolio. So yes, for the short term, there may be a reversal if their challenges are not addressed, but on the long term, no.
Thank you very much. We appreciate your time, Mayowa. And the Food and Agriculture Organization of the United Nations and the International Renewable Energy Agency have partnered to accelerate the deployment of renewable energy technologies in agri-food, fisheries, and forestry chains and sustainable bioenergy. The new Memorandum of Understanding aims to improve the profitability and sustainability of the food and agriculture sectors by accelerating the use of renewables and sustainable bioenergy while fostering climate action and resilience. Energy-smart agri-food practices based on renewables can increase both agricultural productivity, food chain, decarbonization, and food security. Accelerating renewable energy solutions will also boost economic growth and create jobs in a sustainable agro-industry, addressing critical development challenges of the Sustainable Development Goals in developing countries. And Egypt has launched a tourism recovery assistance package with the United Nations World Tourism Organization and European Bank for Reconstruction and Development to ensure their national priorities are addressed. According to Egypt's Ministries of International Cooperation and Tourism and Antiquities, the package will include training in impact analysis, measurement and monitoring of COVID-19 impacts in the tourism sector, the development of tourism recovery incentive programs, and reviews of the effectiveness of operational protocols on safety, among others. Now, the technical cooperation package, which is 90% funded by the EBRD and 10% by the UNWTO, will be delivered by August 2021. Similar support is currently ongoing or envisaged for a number of other countries with economies that are highly dependent on tourism, including Jordan, Morocco, Greece, Croatia, Tunisia, Turkey, Albania, Armenia, Georgia, Lebanon, Montenegro, and Uzbekistan. And Seychelles' government is looking to raise $212 million through the issuing of treasury bills and treasury bonds as the country finds itself in a dire financial state due to COVID-19 and a downturn in travel. The finance minister says that since the start of the year, the amount of money in the government's coffer from which it makes all of its expenses has been zero or in the negative. The minister explains that if the government doesn't find a way to raise finance, there will be no money to pay wages for the next quarter. He further adds that since April 2020, Seychelles has been spending and borrowing to sustain expenses without realizing that the COVID-19 pandemic is a marathon rather than a sprint. And that's a wrap on the program. Thank you for watching.